Hi, welcome back to this my fourth data update for 2023. For those who have been reading all of my posts, and I pity you for having to do that, about a month ago at the start of the year, I promised you a bunch of data posts, about 9 or 10, that would relate to the data from 2022. I wrote the first one. It was basically an introductory post. I wrote my second one, which was on equities, and then I got distracted. I got distracted because the Tesla earnings report was going to come out, and I said, you know what, that might be worth spending some time on, and I went to that. I came back and did a third data update, fully intending to do my fourth data update, but then the Adani Group story came along, and I had no choice but to spend some time there. And I'll make a confession. In my discussions of Tesla and the Adani Group, I've been accused of not being an expert on electric cars or infrastructure, and I'm guilty as charged. In fact, I'm the exact opposite of an expert. I'm a dabbler. And my attention span is that of a flea. I move on from topic to topic. And in this case, spending time on the Adani Group, I don't regret it because it leads in very well to the topic for this data update. Because in this data update, I want to talk about country risk. And the reason the Adani Group story leads nicely into country risk is this is a company, no matter what you think about the Hindenburg claims against them, that's intertwined with the India story. After all, if this is going to be the Indian decade, it's also going to be a decade of significant investment in Indian infrastructure. And here you have a company that is at the center of infrastructure investment and is politically connected. So in this session, I'd like to focus on country risk and what it is that makes us care about country risk. When you think about investing in a country, there's always risk, no matter where in the world you invest in. You could invest in Switzerland, there's risk. What we're talking about are differences in degree. There's more risk in some parts of the world than in others. And the question is, how do you bring that before the risk plays out into your analysis, into your investment, into your valuation? I know we have this developed market, emerging market divide, which makes it seem like country risk is 0-1. If you're a developed market, you have no country risk. You have emerging market, you have a substantial amount. But that I think is a mistake because again, there are developed markets which have significant risk and emerging markets might actually be safer than some developed markets. So in this session, I want to focus on what is it that causes country risk, why it varies across countries, how to measure it, how to bring it into analysis. So in that context, let's step back and think about the forces that drive country risk. And I'm going to list four. Probably there are many I'm missing, but these are the big four. The first is political structure. Now, whether we like it or not, the way politics works out in a country is going to have spillover effects into the economy, into businesses. Now, broadly speaking, you might think democracies are safer than dictatorships or vice versa, but they are trade-offs, right? With democracies, you get what I call more continuous risk. Because the nature of democracies is rules and regulations will change over time because new governments come in with a different point of view than the previous one. Dictatorships offer you the promise of more stable rules and regulations, but the threat there is of discontinuous change because when change comes, it's often overwhelming. It takes the form of a revolution and the government gets overthrown. Something to factor in when you think about political structure and country risk. The second force, of course, is war and violence. Now, needless to say, anybody who's ever operated in a business in a country where you're surrounded by war and violence knows that this adds dimensions of risk to every business that people in peaceful countries can't even think about. So when you think about whether it's internal warfare, external warfare, it creates costs for businesses. Countries with more war and violence are riskier than countries with less. Then there's legal and property rights, right? The nature of a business is you enter into contracts, you need those contracts to be enforced. You own things, you know those ownership rights to be respected. And the place you go to make sure those happen is the court system. If you have a legal system that is capricious, that does not do what it's supposed to, that does not enforce those rights. And that includes legal systems that are late in enforcing the right. If it takes you 30 years to get your property rights enforced, you might as well have no rights at all. That plays into country risk. And finally, there's corruption. I know there are some some who view corruption as a cultural phenomenon. I think it's a reflection of the other three phenomena. If you live in a system where the political structure is unstable and unpredictable, there's war and violence, legal and property rights are not well enforced, you're almost always going to have corruption. And the nature of corruption is it acts as a hidden tax on businesses. Businesses have to build in the cost of corruption into their operating expenses, which reduces the profitability of businesses. So if you think about country risk across countries, you can see the variations on these four dimensions will cause country risk to be different across different parts of the world. Now, as many of you know, when I talk about companies, I'm very fond of using a corporate life cycle to talk about why companies behave the way they do and how you value them at different stages. I'm so fond of the life cycle, I'm going to borrow it and use it in the context of countries. Now, when you think about countries going through the life cycle, this has nothing to do with calendar time, right? You can have countries that are stuck in early stages of growth for hundreds of years, as India was for a while before the last 40 years, or China was prior to the last 30 years. But if you break down an economy, you can think of the economy going through what I call the bootstrap phase, where they have very little resources. The bulk of the population is in poverty. There's very little vibrancy to the economy, even if there are one or two sectors that are delivering some value. You move on, you get focused growth. If you can get yourself out of the bootstrap. Focused growth, you get your growth from one or two competitive sectors where you have a competitive advantage. Japan started its climb to growth by taking on manufacturing in the 1960s and trying to do things more efficiently than companies in the US or Europe. So it's focused growth because you're building your growth around one or two sectors, one or two competitive advantages. And Japan and South Korea used that success in those sectors to broaden out their economies. Now, note that there are some countries that get focused growth from one or two sectors that never break out. The Middle East is still stuck with the fact that it gets growth from its oil riches, but it's never been able to broaden the economy. So there is this question of whether you can make it, but if you do, you're trying to broaden the growth. Once you broaden the growth, you're starting to see a much wider set of sectors grow. At some point in time, your growth will start to level off. You're saying, why? Why can't we keep growing at 8, 9, 10%? Because the math starts to work against you. Just as company growth starts to converge on the growth rate of the economy, the growth rate of countries starts to converge on the growth rate of the global economy. There's a reason why growth in China has dropped from double-digit levels to 4 or 5%. And that's assuming the Chinese government is not playing with those numbers. The reason is simple. China is the second largest economy in the world. You can't grow 10% a year. Let's call that mature growth. Once that mature growth starts to level off, you're just struggling to stay at where you were. It's a period of stability, but you're going to realize you're not going to be able to do the things you did during growth. And there's finally decline. Unlike companies that decline and go away, countries decline and they stay faded. So you can think of countries moving through the life cycle. And the reason this might help understand country risk is I'm going to look at three factors and how they evolve over the life cycle. Let's start with the government. Do governments matter? Yes. How much do they matter? It depends. When economies are young, I think government actions or inactions can be central to how quickly the economy can grow. Governments matter a great deal with young, growing economies that are still trying to find their feet. As economies mature and find their footing, it's not that governments don't matter, but they will become less important, less central to the economy. Their effects will be more at the margin. And then once you start to go into decline, governments come back again as more central actors because they will determine how quickly you decline with their policies. And they also have to decide who bears the pain, because when you decline, there is going to be pain. So the effect or the importance of governments vary across the life cycle. Second, think about country narrative. What is that? Every time you look at a country, you have a narrative for how that country will evolve over time. You might have an optimistic narrative or a pessimistic one. Early in an economy's life cycle, every company, every investment in that country will have a country narrative component. When you buy Dangote cement in Nigeria, whether you like it or not, your valuation of Dangote cement, what you think about it, is going to be tied to what you think of Nigeria as a country. So early in the process, country narrative often will dominate what you think about companies and investments in whether you invest. As countries mature, it's not like country narratives go away, but they go to the background. When you're investing in a US company, it's not the US economy that is the central force driving your investment. It's that you like the company. So company narrative comes back to the front. It becomes more critical to success. Now, as countries go into decline, country narratives still stay secondary, but they will acquire more importance than they did when the country was growing or mature. So you can see how country narratives play out. And the way this plays out in valuation is when you're valuing a developed market company, you can afford to focus just on the company and ignore the macro factors, ignore the government. You can't do that with an emerging market company. And finally, if you frame economic and the country life cycle through uncertainty, uncertainty is obviously greatest when a country has not found its footing, when it's still trying to figure out what to do. It'll decrease as economies mature. Now you might wonder, why should I care? Why should I care that the government has a smaller effect in some economies and a larger effect in others? Or that a country narrative matters more in some countries than in others? It's because as investors or in running businesses, we're often told stories about how to approach investing. And I remember a long time ago, early in my investment journey, I talked to a value investor, an old-time value investor, somebody I respect, and he said, when valuing a company, just focus on the company. Focus on its management, its moats, the company itself. Don't worry too much. And that's good advice, but don't worry about macro factors in the government. Doesn't mean you shouldn't think about them. In fact, while it was okay to value companies without ignoring the government and macro factors in the US in the 1960s, the 1970s, perhaps in the 1980s, I don't think you can get away ignoring the government. You might not have to take a point of view of which direction the government is going to go, but you got to factor it into your story and your valuation if you're valuing a company in India, Indonesia, Brazil, or even in the United States in 2023. So with that lead in, let's talk about how best to measure country risk. The most widely used measures of country risk tend to be measures of default risk, because governments do default. It's called sovereign default. So let's look at a couple of slices of sovereign default so we can understand it better. First, let's look at what parts of the world you're most likely to see sovereign defaults, and it's no contest. If you look at sovereign defaults between 1980 and 2018, and you can go back 200 years and this still remains true, Latin America remains the epicenter of sovereign defaults. More than 50% of all defaults during this period came in Latin America, followed by Africa, Europe, and Asia, surprisingly few defaults. Of course, these numbers shift with each added year. So last year, 2022, for instance, you had 5 sovereign defaults. 2 were related to the Russian invasion of Ukraine. Russia and Ukraine both defaulted. But 2 had nothing to do with Russia, Ukraine. Sri Lanka and Ghana also defaulted. So these numbers keep getting added on. The geographies will get updated, but that's one feature of sovereign defaults. It's geographically concentrated. Second, if you look at what type of debt borrowers default on, remember, a country can borrow in its own currency or in a foreign currency. It is true that foreign currency defaults are more common, but it's also true that governments often default in the local currency. In fact, it happens surprisingly frequently. Why surprisingly frequently? Because the pushback you get is, hey, why don't governments print more money and just pay off the debt? The answer is they don't want to debase their currency. They'd rather default. Now, you might wonder again what implications this has, and I'll tell you one implication it has for me. When I was taught finance, I was told to use the government bond rate as my risk-free rate in a currency. Not bad advice if you're the Swiss government, or the German government, or even the US government. But would you do that for the Nigerian government? In fact, I think to get a risk-free rate in currencies, you need to start with the government bond rate and take out the default spread from it. It's a practice I started using about 15 years ago, and I continue to use to get risk-free rates in different currencies. So the way to read this graph, the full height of the column is the government bond rate. The red portion is the default spread. The blue that's left over is the risk-free rate in a currency. Now, just as an aside, if you're wondering why risk-free rates vary across currencies, that's a topic for a different day. But it's just expected inflation that causes these differences. High inflation currencies have high risk-free rates, and low inflation currencies have low risk-free rates. Deflationary currencies could have negative risk-free rates. Now, if you think about how to measure default risk ahead of time, rather than wait for default, the most commonly used proxy for default risk is sovereign ratings. Now, ratings agencies get a lot of abuse, but then they do provide a service. They provide a service by rating companies, which is what they start with, but also countries. And the number of countries that they rate has grown over time. Just go back, to 1990, Moody's had about 33 countries, S&P had 35, but those numbers had risen to 152 for Moody's and 131 for S&P at the start of 2023. Clearly, people want sovereign ratings. Now, sovereign ratings look a lot like corporate ratings. They go from AAA today, but there are some differences. The first is, while each company generally gets one rating, its bonds might get multiple ratings, but there's a company rating. Countries are usually assigned 2 ratings, one for local currency borrowing and one for foreign currency borrowing. The second is the fundamentals that feed corporate ratings tend to be primarily financial. There are some qualitative factors that play out, but much of it comes from ratios that you compute using the financials reported by the company. When you assess ratings for countries, it's true there are quantitative measures that get looked at, how much debt the country has, how much it collects in taxes, but there's a lot more fuzzy factors, qualitative factors that come into play with sovereign ratings. So let's look at what country risk or default risk look like through the eyes of ratings agencies at the start of 2023. So I took Moody's. You could do this with S&P or with Fitch, but Moody's is the most countries, I think, on its rating radar right now. And I broke them down from AAA all the way down to below C. This is CAA1 all the way through C. So if you look at the red parts of the world, the red and orange are the riskiest parts of the world according to Moody's. And you can see that they're disproportionately located in Latin America, in Africa, and increasingly in Eurasia. The Russian invasion of Ukraine has created some consequences. Now, of course, many people in these parts of the world believe that ratings agencies are biased against their regions. I can't disprove it. But from my observation of ratings agencies, my biggest problem with ratings agencies is not that they're biased, but that they're late to the party. By the time they tell you that a country is in trouble, everybody knows they're in trouble. So one way in which you can get around the fact that ratings are often lagging indicators is to look for a market measure of default risk. And starting about 20 years ago, a market provided that's called the sovereign CDS market. It's a market where you can go and buy insurance against default risk from sovereigns. So it's actually a daily or an hourly, minute-by-minute update of what the market thinks about the default risk for a country measured as a spread. In January 2023, there were 76 countries with sovereign CDS spreads. So already you can see this is not as widespread as ratings, which cover 150 or 160 countries. You have only 76 countries. And if you look at the sovereign CDS spreads for those 76 countries, you see it takes the form of a percentage. Basically, the higher the percentage, the more default risk there is because it's costing you more to buy insurance. So as an example, if you take Brazil, the way to read that sovereign CDS spread is if you bought a dollar-denominated Brazilian bond, government bond, you could buy insurance on this market by paying 3.52% of whatever the coupon is on the dollar bond from Brazil, and paying it to the insurer. Now, there are issues with the sovereign rating CDS market that are not worth exploring here. But there are benefits and costs to using a market-based estimate of default risk, right? The benefit is it's constantly updated. It reflects what's happening in the moment. The minus is markets often overreact. So take it for what it's worth. I think it's good to have a second proxy for defaulters that you can use to check to see whether ratings are lagging indicators of something that's coming down the pipe. Now, both the sovereign CDS spread and sovereign ratings focus on default risk. And you can argue that there's far more to country risk than just focusing on default. Or put simply, there are countries that have low exposure to default risk but are still risky because they're risky on other dimensions, on political risk and economic risk that's not in that default risk. There's no easy remedy to the problem, but there are political risk measurement scores. The World Bank has some, The Economist has one. I've used this service called Political Risk Services, and I'm going to report the numbers they report, not because I think they're superior to everybody else, but because I'm more familiar with these numbers. So the way these numbers work is they go from low being risky to high being safe. And this is one of the problems using risk scores, is they're all over the place in terms of how they're measured and what dimensions they take. So the start of 2023, this is what the PRS scores look like for the world. Again, the red parts of the world are the riskiest parts and the green parts are the safest. And unlike sovereign CDS spreads and sovereign ratings that tended to kind of overlap, the same parts of the world look risky. When you look at the PRS scores, at least at the start of 2023, there are some interesting differences. Take it for what it's worth, but according to PRS, India is safer than China. It's not true on the default spread measure. The US is barely safer than India or China. And Kazakhstan is safer than all three of them. So already you can see when you go down these political risk measures, you're buying into a measure of country risk that you might not or might not like, but at least it comes with this hope of it's capturing more dimensions of risk. Of course, that's default risk. You're saying, what if I'm interested in investing in the equity in a country? And this is true if you're a company investing in a project in a country as well. You're saying, how do I come up with an equity risk premium for a country? I won't bore you with an elaborate description of what I do because you can go to my website, you can download the paper. I describe this in excruciating detail, but I'll go through how I estimated equity risk premiums at the start of 2023. I started with the equity risk premium for the S&P 500. If you remember a couple of sessions ago when I was talking about an implied equity risk premium for the S&P 500, I went through the process and I came up with an implied equity risk premium of 5.94%. I start with that. I call that my mature market premium. Maybe that's parochial of me, but that's what I start with. I attach that premium to every AAA rated country in the world. I'm making the assumption that AAA ratings equate to mature markets. If you're not AAA rated, I take the rating and I come up with a default spread based on the rating. And then I make a stop. These default spreads are what I would charge for buying a bond. I scale that default spread up. And remember, you can get the default spread by either using a sovereign CDS spread, you can use the spread on a sovereign bond, you can use the ratings table. I scale it up. And I scale it up to reflect the fact that equities are riskier than bonds. And that scalar was 1.41. So if your default spread is 2%, I multiply by 1.41, I get 2.82% as your additional risk premium. Let's call it a country risk premium, which I add on to my mature market premium. You add 2.82 to 5.94%. You end up with 8.76% as your equity risk premium for the country. And I do this for every country. So the start of 2023, this is what the world looked like to me. Again, take it for what it's worth. Now, I've admitted, I think openly, that there is no intellectual firepower behind these numbers. They start with default spreads, but the one thing they have going for them is consistency. I do it exactly the same way for every country. In fact, I have included countries which don't have a rating. And you might wonder how I got their equity risk premiums. I cheated. I looked up their PRS scores, the Political Risk Service score, and I found other countries with similar scores which had ratings, and I attached the equity risk premiums from those countries to the country in question. So I've got pretty much the whole world, and again, the red parts of the world are the riskiest parts of the world if you're an equity investor. Lots of Africa, again, Latin America and Eurasia, Russia and the countries right next to it. The safest parts of the world, Europe, North America, US and Canada, Australia. But you can see that this is a map in process. As each year, you're going to see countries move in and out from safe to risky or risky to safe. So it's my measure of equity risk premiums. It's been a long session, but let me wrap up. Now, I'm not interested in valuing countries or valuing economies. I'm valuing an interest in valuing companies. And one of the things I've always found troublesome about the way people approach country risk is they look at where a company is incorporated and give it the equity risk premium of that country. So all Indian companies get the Indian equity risk premium. All US companies get the US equity risk premium. And that struck me as, it's indefensible. I mean, if you're a US company and you get 80% of your revenues in Brazil, why would I be attaching a US equity risk premium to you? So I've pushed, and perhaps not successfully, that the way we estimate equity risk premium for companies should reflect where they do business. Now, I'm willing to debate how to measure the exposure to where they do business. You can use revenues, especially for consumer product companies. You can use production if it's an oil or natural resource company, or a mix of revenues and production if you're a manufacturing company of some sort. But I think that makes more sense. So you tell me where you operate, and I'll take a weighted average of the equity risk premiums of the countries in which you operate. So if you use that approach, you can already see that it's not where a company is incorporated that drives their equity risk premium. It's a breakdown of their business. There are implications, right? To the extent that investors and analysts continue to go the old-fashioned route of treating all Indian companies as having Indian equity risk premiums and all US companies as having US equity risk premiums, there are going to be predictable consequences. I think they're going to overvalue developed market companies that have significant emerging market exposures. You can see why, right? Because they give those companies developed market premiums. I think they're going to undervalue emerging market companies like Infosys, like Embraer, like Vinamilk, the Vietnamese dairy company, which have significant exposures outside that emerging market. And you know what? Don't try to talk people into doing the right thing. Take advantage of it. The next time there's a crisis in emerging market and foreign institutional investors sell all companies in that market and flee, it's a time for you to step in and buy a company in that market that might have exposure outside and it's being punished unfairly. So here's the long lead-in. Now, I've talked about country risk. I've talked about the role of governments. I'm going to end with something that might seem like a side story, but to me is something worth thinking about. I've always tried to figure out what a good government does. Now, a good government to me provides the structure, the laws, the regulations, the rules that allow an economy to go from bootstrap to focused growth, to widespread growth, to being a growing economy. But a good government also knows when it should fade into the background. In other words, I think of a good government very much like I think of a good founder. A good founder to me, or a great founder, is one who creates a great company and then works as hard as he or she can work to make the company be able to survive without them. A good government does exactly the same thing. And so a good government tries to make itself less central, more tangential. I know this cuts against the prevailing wisdom that governments need to be more at the center of actions. But I think that, and while it might sound like the libertarian position, it's not. I do believe that it is the government's role to craft laws and regulations that minimize the externalities that businesses create. In fact, that's my argument against ESG. Rather than let CEOs do it, that is the government's role. I do believe, though, that those rules, laws, and regulations should be few in number. Changes, when they happen, should be reasoned and infrequent, and enforcement should be fair and timely. Less is more. I mean, there's nothing more unsettling than running a business or being a citizen, a voter, a consumer in a setting where the rules keep changing on you. They're contradictory. They're enforced sometimes. They're not enforced. So this is not an argument for government to go away. It's for government to make itself less central to business success. So I hope you found this session useful, and thank you very much for listening.